Good morning, and thank you all for joining us today. You've made the choice to take a break from the craziness that we're all involved in now, and we hope today will be an opportunity for us to provide not only something informative, but hopefully as well a little bit entertaining through your participation as you listen to the webinar today. You're certainly all aware of the topic, but maybe just a little housekeeping beforehand. You may wish to go up into the upper right-hand corner of your Zoom features and choose the speaker view. And then also moving over to viewing options to be able to choose the side-by-side. And that'll give you an opportunity to see not only the slides, but also the activity with the speakers as well. So I wanted to take the opportunity today on behalf of the Center for Carbon Management and Energy at the University of Houston to welcome you. My name is Chuck McConnell, and we're blessed today to have, I think, one of the more important topics going on in carbon management in terms of carbon capture, utilization, and storage, and the incredible need and opportunity to advance this technology and this value proposition in the marketplace for broad commercial deployment and moving it forward. Certainly the 45Q IRS guidance is a big part of that story in terms of enabling things short term and longer term as well. And so hopefully today's discussion will not only give you an insight into our Carbon Management Center, but also give you an opportunity to become more involved in the University of Houston's carbon management activities as well. We have a series of webinars that are set up for the rest of this month, as well as the months of May, and we anticipate going into June as well. We will be providing this platform from 10:30 to noon Central Time every Thursday for the rest of the month, and hopefully address a number of topics in the carbon management arena that are important, certainly today, but as part of our energy transition going forward. And so we hope you can join us every Thursday if you can, and find time in your schedule to be a part of it. Especially today, as well as for the rest of the month, we want to thank our sponsor, Hunton Andrews Kurth. They have been a generous sponsor of the series for the rest of this month, but also a member of our Carbon Management Center here at the university, have been a strong supporter from day one. Any number of the attorneys at Hunton are former UH grads and Cougars themselves. And so we're very fortunate to have that sponsorship. And we want to, again, thank Hunton Andrews Kurth for their support. As I mentioned, the rest of this month, we have a series of topics that you can see are going to cover the landscape of a number of areas in carbon management. Next week, John Hoffmeister will speak about the current circumstances that we're in, not just about the coronavirus, but certainly the economic conditions, demand destruction, concerns, etc., but also what kind of tailwinds we might be able to expect in the marketplace. Following that, the next week, Nigel Genvy will join me and talk about the CCUS landscape and being able to get these projects deployed, moved forward, and what it's going to take to make that happen. And frankly, we've been through this 10 years ago as we looked at the projects that were part of the Recovery Act. We're in a similar circumstance today. What kind of lessons learned? What did we do well? What do we need to do better? The next week will be David Greason, who's one of the more expert people we have in the marketplace in terms of project deployment. He was the primary mover behind the Petronova project here in the Houston area. It continues to work on CCUS project development, and there's nobody with a more deep and rich understanding of what it takes to get things done. And then finally, at the end of the month, we're going to have a conversation with two of our leading folks that are in our faculty at the University of Houston regarding the legal ethics of carbon management. It's a huge topic that many companies around the world have talked about, made commitments to move forward toward a carbon neutral energy transition. And what are the ethics that are associated with that short term as well as long term? So I think you'll find these topics to be of interest, and in the similar format that we're using today, we'll have a prepared presentation and encourage everyone to be a part of that. So please go to our website, have an opportunity to learn more about each of these topics, and also be able to register as well as you have for today, because that'll be important for you to get involved and also to be online and involved in each of these presentations. So please join our website. As I mentioned, as we're going through today, we're going to have the opportunity for you to be able to participate using the chat function on the Zoom platform. That chat function will allow you to ask questions as we go through the prepared material. Also, you'll be able to ask questions as we're answering those questions at the end of the presentation. But feel free to interject your questions, and we'll assemble them and hope to take as big of a broad brush at answering a host of those questions in the time that we have before we conclude at 12 today. And so that gets me to David Lowman, who will be our featured speaker today. David is one of the preeminent people and resources in the carbon capture, utilization, and storage landscape. He's got a tremendous practice at Hunton Andrews Kurth. Much of the experiences that David's had over the years in the wind and the solar industry and the renewables area, also now moving that practice and that capability as well and broadening that out into the Hunton portfolio as it relates to CCUS and the IRS guidance. This IRS guidance has been a critical part of what we need to move this technology forward. And I don't believe there's anybody in the marketplace that can address this with any greater detail than David. So we'll present David here in the next hour. Please, again, use your chat functions to ask your questions as we go along. And I think you'll find that the information provided here will be quite insightful and certainly in depth. So, David, thank you.
I hope this will be informative with respect to the Section 45Q tax credit, carbon capture. What we want to do today is first give you a general overview of the Section 45Q tax credit so that we can sort of put into focus some of the guidance that the IRS has issued. The IRS has issued two pieces of guidance so far. Back on February 19th, they issued IRS Notice 2020-12, which provides guidance on satisfying the beginning of construction requirement. And I'll explain to you what that means and how that requirement works. The second piece of guidance that they issued is IRS Revenue Procedure 2020-12, which provides a safe harbor for structuring tax credit investments using a partnership. And we'll go through that safe harbor structure and explain how it might be applied for purposes of monetizing the tax credit and bringing tax equity investors in to use the tax credit. Now, what we haven't seen yet are a third piece of guidance from the IRS and Treasury, which is expected to take the form of proposed and temporary regulations. The proposed and temporary regulations will deal with all of the other issues associated with the tax credit, including things like defining secure geological storage, how you go about proving sequestration, what the requirements are. There are recapture provisions provided in the code. What are the conditions under which the tax credit might have to be recaptured? And these regulations will go into other definitions and procedural requirements with respect to the tax credit. Issues like how do you go about doing the measurement? What is the definition of utilization? So forth and so on. Now, the status of those proposed and temporary regulations is that we understand that about a week or so ago, the draft of those proposed regulations was sent over to the Office of Management Budget for its review. So they should be out relatively soon. Let's start with a general overview of the tax credit. The Bipartisan Budget Act of 2018, which was enacted on February 9th, 2018, significantly increased and extended the tax credit for carbon capture and sequestration. This tax credit had been around since about 2008. It was expanded to a significant amount here, and the tax credit is providing a potential significant opportunity to financially support through the tax credit the development and deployment of carbon capture and sequestration, something that had been sought by emitting companies, oil and gas companies, and other industrial users. So the tax credit, as it was originally enacted, was $10 per ton for CO2 permanently stored and used as a tertiary injectant. Enhanced oil recovery, we'll refer to it as EOR, and $20 per ton for carbon dioxide not used as a tertiary injectant and permanently stored in a secure geological formation. That's just sequestration. And the theory behind the differentiated credit was that the market would pay for CO2 for use in tertiary injection, for use in EOR. The tax credit is indexed for inflation and has been increased. The tax credit still applies at those rates to carbon capture equipment that was placed in service prior to the enactment of the Budget Act. Now, how was the tax credit increased or changed in 2018? The first thing is that it created a higher tax credit for carbon capture, secure geological formation. It continued the credit for use as a tertiary injectant, and it continues the difference between those two. While the budget, what I'll refer to as the old Section 45Q tax credit limited total production to 75 million tons, the current, or what we'll refer to as the new tax credit for projects placed in service after February 2018, provides a 12-year tax credit from the original placed in service date for projects that begin construction before January 1st, 2024. We're going to explain to you what the begin construction requirement is in a few minutes. So there are different requirements for the size of facilities, depending upon the amount of carbon dioxide that's emitted and how that is used. These will be issues that are explained in greater detail in the forthcoming proposed and temporary regulations.
Here's a chart which shows you the difference between the old tax credit, the pre-Budget Act tax credit, and the post-Budget Act. The tax credit for use in EOR or other industrial uses is ratcheting up on a linear basis through 2026. In 2026, it will be $35 per ton. That is per metric ton of carbon dioxide that is used for EOR or utilization, other purposes, which will then have an inflation adjustment factor applied to it on a going forward basis. That credit will be applicable or will be available for 12 years from when the carbon capture equipment is placed in service. With respect to sequestration, the credit is currently ratcheting up, and effective 2026 will be $50 per ton. Thereafter, with an inflation adjustment factor applied, again, for 12 years. This is a very rich tax credit and something that folks are very interested in, and we hope to see it be successful. So, what is qualified carbon oxide? And first, the term was carbon dioxide in the old bill. It has been modified to carbon oxide. So it's not limited to carbon dioxide. It could be carbon monoxide. But qualified carbon oxide means carbon dioxide or other carbon oxide which is captured from an industrial source by carbon capture equipment, another defined term we'll get into, carbon capture equipment, originally placed in service on or after the date of the Budget Act, which would otherwise be released into the atmosphere as an industrial emission of greenhouse gas or lead to such release. It has to be measured at the source of capture and verified at the point of disposal, injection, or utilization. Obviously, you're going to measure that. You're going to keep those measurements on a metric ton basis. Now, in order to qualify for the credit, once you've captured the qualified carbon oxide, must be used as a tertiary injectant, that is for EOR, or permanently disposed of in secure geological storage, sequestration, or used for other industrial purposes. Now, what are utilization for other industrial purposes? It means the fixation of carbon dioxide through photosynthesis, chemosynthesis, growing of algae or bacteria, the chemical conversion of carbon dioxide to a material or chemical compound which securely stores such carbon dioxide for any other industrial use. So taking and using the carbon oxide to build building material where the carbon oxide is captured within a product like a cement or similar would be a qualified utilization. Again, that's a topic that will be addressed in the IRS proposed regulations to be issued. Now, the term qualified facility, and look at the definitions here. The term qualified facility means any industrial facility or direct air capture facility, the construction of which begins before January 1st, 2024, and construction of carbon capture equipment begins before such date, or the original planning and design of such facility includes installation of carbon capture equipment. Here's where your beginning of construction requirement comes into play. Now, the industrial facility definition is really the source of emission of the CO2. Could be an existing plant, such as an electric generating facility, an ethanol plant, or fertilizer plant. Such facilities can be retrofitted with carbon capture equipment. And I think that what we will see with respect to this tax credit in the first round of development here will be the retrofitting of existing emission sources, ethanol plants, fertilizer plants, etc., with carbon capture equipment. So the focus is really on the carbon capture equipment, and construction of that carbon capture equipment must begin before January 1st, 2024. Now, the IRS has issued 2 rounds of guidance here, or 2 pieces of guidance. The first is the IRS notice 2020-12, and it defines carbon capture equipment as follows. Carbon capture equipment includes all components of property that are used to capture or processing, including separation, purification, drying, and/or compression, carbon oxide until it is transported away from the qualified facility for disposal, utilization, or use as a tertiary injectant. Okay? Now, that would include gathering lines that collect the carbon dioxide or carbon oxide captured from the qualified facility, or multiple qualified facilities that constitute a single project. And we'll look at what this single project is in a few minutes. It includes such capture equipment and gathering lines up to the point of a pipeline used to transport carbon oxide from multiple taxpayers and projects. What is the focus here? Carbon capture equipment is the equipment used to capture and process the carbon oxide. Carbon capture equipment ends at the point where the carbon oxide is delivered into a pipeline, if that is a pipeline of the nature that it would be used by any other taxpayers out there, other businesses, and so forth. So the definition of carbon capture equipment is relatively narrow in that it's the capture equipment up through the point at which carbon oxide can be delivered for transport. It is not the pipeline. And quite frankly, it is not the point at which the carbon is sequestered. This is going to be important for a couple of reasons. One of the reasons is that once we get into structuring transactions, you're going to see that the taxpayer that's entitled to the credit is the taxpayer that owns the carbon capture equipment. And so a more narrow definition may be favorable in structuring a transaction and ownership. But the second issue is with respect to beginning construction, because you must begin construction on carbon capture equipment, where, for example, we're retrofitting an existing industrial facility. What we're going to find out here is that the definition, while narrow in terms of defining carbon capture equipment, that beginning of construction can be extended to a broader range of equipment that is integral to the carbon capture equipment, which is going to provide some relief on what equipment you must begin construction on. We'll go into a little detail here. Now, what does beginning of construction mean? How do you establish beginning of construction? These rules are well understood in the tax credit industry, so to speak. The same requirement, beginning of construction, applies to other tax credits such as the wind Section 45 tax credit. It applies to the Section 48 investment tax credit for solar facilities and other facilities. So these definitional rules here are fairly well understood by folks that work with tax credits. So this industry need to understand. Two ways to establish beginning of construction. One, starting physical work of a significant nature. We call this the physical work test. Or the second is a safe harbor. Paying or incurring 5% or more of the total cost of the qualified facility prior to the date, prior to the current date of January 1st, 2024. So you can start physical work, you can go out, put a shovel in the ground, or start working on component physical work, or you can incur the cost. And really here we're probably focused on incurring, which is an tax accounting term for accrual basis taxpayer. You accrue 5% or more of the total cost of the qualified facility or carbon capture equipment. Two tests. Now, once you satisfied the beginning of construction requirement under either the physical work test or the 5% safe harbor, you must make continuous progress towards completion once that construction has begun. So you've got to keep working, so to speak, and we'll explain that. There is, however, a safe harbor that's being provided, which says that the continuity requirement will be deemed satisfied so long as the facility is placed in service within 6 calendar years from the year in which construction first began. So under the 6-year continuity safe harbor, if you begin construction in 2023, you have until the end of 2029 to place the facility in service. Means you don't have to examine the facts and circumstances as to whether you have been continuous in fact. This 6-year continuity safe harbor is an additional 2 years from what is allowed for wind and solar projects, which are only given 4 years. So what is physical work? Physical work focuses on the nature of the work performed, not the amount of work, the number of hours, or the cost of such work. It is the nature of the work that's performed. So long as the work is of a significant nature, there's no fixed minimum amount of work or monetary threshold necessary to satisfy the physical work test. Work can be performed by the taxpayer, or work can be performed for the taxpayer by other persons under a binding written contract that is entered into before the work starts. And that work by a contractor or manufacturer under a binding written contract can be used to establish beginning of construction and physical work. What's a binding written contract? Binding written contract means it's enforceable under local law and that it does not limit damages to an amount less than 5% of the total contract price. That means that you cannot have liquidated damage provisions that would limit the damages to an amount less than 5%. That's a binding written contract. You get the binding written contract in place in advance of the work being done. Now, work can be done on site or off site. The work, you've got a particular project where you're going to install carbon capture equipment. You do not have to be on site. You can be beginning work on the equipment that will be used for carbon capture. And that manufacturing work, that physical work to manufacture, fabricate, or construct that items can be off-site. It can begin at the manufacturer's place of business at its manufacturing facility. So what are some examples of off-site work of a significant nature? This is language from the guidance. The manufacture of components, including but not limited to mounting equipment, support structures such as racks and rails, components necessary for carbon capture processes such as membranes, sorbent vessels, absorbers, compressors, other types of gas separation, liquefaction, or processing equipment. Those are just examples. Also, and this is important, the manufacture of equipment necessary for disposal of qualified carbon oxide in secure geological storage, such as wellhead equipment, booster compressors, and monitoring equipment for storage. Here's the point I referenced earlier, which is the definition of carbon capture equipment is limited to the equipment necessary to capture the carbon oxide and process it up to the point of delivery to a pipeline, etc. It is limited, but for purposes of beginning of construction, the IRS is allowing you to look at equipment such as equipment necessary for disposal that is not technically capture equipment. But as long as you begin construction, begin physical work, or incur cost of equipment that's going to be used for sequestering or wellhead equipment, etc., they will treat you as still satisfying the beginning of work standard for carbon capture equipment. Okay? Now, note this with respect to a manufacturer. If you're entering into a contract to have a manufacturer, a fabricator, manufacture components for you, these have to be specially contracted for items. They cannot be a component or item that the manufacturer has in existing inventory or would normally be held in inventory by a vendor. For example, if your carbon capture project and the equipment you used had, let's say, a pump, and it's just the regular pump that you could go down to the warehouse, a manufacturer, a vendor, and buy, having someone manufacture that item for you doesn't count. On the other hand, if the equipment is of a specialized nature, or if the manufacturer only manufactures items when it receives an order, so they're like, they have to get the contract before they would start to fabricate the item. They do not hold these items in inventory. That is okay. That would qualify. But you can't just buy an off-the-shelf item with respect to physical work. Having someone do physical work on an item that they otherwise have in inventory does not count. Now, let's talk about the master contract rule, because what this is going to do is to allow a developer to develop or begin construction on multiple projects through a master contract with a manufacturer or fabricator who is going to produce items for them. What's the master contract? Under the master contract rule, if a taxpayer, let's call them the developer, enters into a binding written contract for a specific number of components to be manufactured, constructed, produced by that contractor through a new binding written contract, you can then assign those components that are manufactured to an affiliated special purpose entity that will own the qualified facility or carbon capture equipment. What does that mean? Here's the way this would work. Developer enters into a master contract with a manufacturer to produce 10 compressors of the type that it will deploy in 10 different carbon capture projects. The manufacturer produces the 10 compressor units, does physical work on those 10, and that is significant physical work to manufacture those 10 components. Developer then identifies 10 project sites. Those 10 projects don't have to be identified at the point in time that the developer contracts for those units of property. It's perhaps still in negotiations with different ethanol plants or other types of emission sources where it's going to place. It has the 10 compressor units. They're going to be used at 10 different projects. And as a project is then identified by the developer, it sets up a special purpose entity to develop the particular project, and it can then assign one of the compressors to each of those special purpose entities that set up, each at a different project site, and then it's begun construction effectively on 10 different projects potentially. That's an important rule for you. So you don't have to have the project identified at the time the order is placed. You can later assign those components to different projects owned by different special purpose entities set up to develop the projects. Now, the physical work test, we just talked about off-site physical work. We can also talk a little bit about on-site work. This is a non-exclusive. You can have excavations for installation of foundations, setting of anchor bolts into the ground, the pouring of concrete pads and foundations. You could potentially have service roads that are put in to facilitate the servicing of the physical plant, the gathering lines necessary to connect the industrial facility to the carbon capture equipment, and so forth. Those are the types of things that you would expect. So here are a list of on-site work. Installation of components necessary for carbon capture processes, such as membranes, sorbent vessels, absorbers, compressors, reboilers, turbines, pressure vessels, etc. Piping and pipelines at the carbon capture site. Here's a list. It's all going to depend upon the type of equipment you have, up through the separation, liquefaction, and processing equipment. And then, again, as we noted before, we will expand the scope of equipment that you can use to establish beginning of construction to include work on at the sequestration site, which may be at a different location than the qualified facility or the carbon capture equipment. So wellhead equipment, etc. It's not carbon capture equipment. Nevertheless, it's integral to the project, and physical work on this can satisfy the test. Now, physical work does not include preliminary activities and non-physical activities like securing financing, exploring, obtaining permits and licenses, and so forth. It needs to be physical work, and physical work that is of a significant nature, not just preliminary. What's the second way to establish beginning of construction? That would be the 5% safe harbor. I will tell you that many investors prefer the 5% safe harbor because, as its name suggests, it's a safe harbor, and you don't need to question whether a certain amount of work is significant. So the 5% safe harbor, you must incur 5% or more of the total cost before January 1st, 2024, and then make continuous efforts to advance towards completion. Satisfy the continuous efforts test. We've already talked about the 6-year safe harbor for being deemed to satisfy that test. Now, for an accrual basis taxpayer, means the cost is incurred. That means you have economic performance under the Section 461H rules. That means for you that that the property or service must be delivered to you, and you accrue or incur the cost upon the delivery of the property or service. Now, the notice does allow a look-through for cost incurred by a contractor or manufacturer for property that is manufactured, constructed, or produced pursuant to a binding written contract with the taxpayer. Only one level of look-through is allowed. So cost paid or incurred by a subcontractor to the prime contractor do not count. What does this mean? The look-through rule essentially means rather if you contract with a manufacturer to manufacture carbon capture equipment components, and the manufacturer is incurring costs either for its employees, for its supplies, with its subcontractors, and you have an agreement with that manufacturer to be able to look at its cost, the cost of the manufacturer can be used to satisfy this 5% test. Now, all costs that are properly included in the depreciable basis of qualified facility are taken into account. This includes preliminary activities that would not qualify for physical work. So even though you've got planning, you've got engineering, design costs, things of these nature that are not physical work, the cost of those items that would be capitalized into the asset can be used for purposes of the 5% safe harbor. And the regulation makes clear, or the IRS guidance makes clear, that front-end engineering and design and front-end planning are considered when determining whether you satisfy the 5% safe harbor. We talked about the master contract rule. That's where you can enter into a contract to have multiple units of property manufactured. You then assign those component costs to various projects. You can use that master contract rule also with respect to the 5% safe harbor. Now, let's talk about taxpayers. Once you establish beginning of construction, you can transfer the project to a new owner. So a fully or partially developed qualified facility, carbon capture equipment, may be transferred without losing its qualification under the physical work test or the 5% safe harbor. You may also begin construction at one site and thereafter transfer or relocate components to a different site. Complete the development, place it in service, you're still qualified. So if you begin construction at one project site and it just doesn't work out, you can pick that equipment up, relocate it to another project site. It will still retain its placed in service, or its beginning of construction qualification. What is restricted, however, is simply solely personal property. So if you have ordered those 10 units, those 10 compressor units, for example, and you're claiming beginning of construction for those for those units and for projects associated with those units, you cannot simply sell one of those compressors to another taxpayer and claim that that compressor satisfies beginning of construction. If the equipment is associated with other assets or attributes that would suggest you have a project, so you've got a license, you've got a contract with someone to place the unit at the property, and you transfer the unit of property, the unit of personal property, the compressor I referenced, to another taxpayer, to a purchaser, along with the contract, etc., that would qualify. And your tax lawyer can walk you through this. So transfer it along with other rights, lease rights, licenses, permits, contracts, then that can qualify. That takes care of the beginning of construction requirements. You know, there are folks in the industry that are out looking for an extension. The rules that have been provided to you on beginning of construction are fairly liberal. They expand the scope of the property from merely carbon capture equipment to including the sequestration equipment. You've got a 6 calendar year term to get the equipment in service. I think those are provided some rules that we'll be able to work with. Let's turn to the second topic here, which is monetization of the tax credit. Who can take advantage of the tax credit here? We saw those numbers, those credit amounts up front, $35 per metric ton for EOR, $50 per metric ton for sequestration. If you consider a industrial facility as one that produces 1 million tons of carbon oxide a year, you would be looking at tax credits from 35 million to 50 million, depending on how you use it, per year for 12 years. You're going to need an investor that has a very significant tax appetite to take advantage of that tax credit. Now, how do we monetize the tax credit? How do we bring the value in through an investor? The credit is attributable to the person that owns the carbon capture equipment, and the owner of the carbon capture equipment either physically or contractually ensures the capture and disposal, utilization, etc. We're going to approach this from the view that sponsors and developers will often not have sufficient tax liability to realize the benefit of the tax credit, and that they'll need to bring in an investor that has the ability to fully utilize the benefit of the tax credit. We call those investors tax equity. And there is a very large tax equity investor for other tax credits, such as wind and solar and low-income housing, etc. We expect the market to develop here with respect to 45Q. Now, what is anticipated with the IRS guidance on partnership structure is that a tax equity structure would likely involve the use of a federal income tax partnership between the tax equity investor and a developer. The partnership would own the carbon capture equipment. Again, to claim the credit, it's the owner of the carbon capture equipment. So the partnership is formed to own the carbon capture equipment, and then the partnership that owns the carbon capture equipment will contract for the sale or disposal of the carbon dioxide. The tax credits accrue to the partnership and then will be primarily allocated to the tax equity investor until the investor earns its designated after-tax return, after which the tax equity investor's interest would flip down to 5%. This is called a partnership flip structure. Now, the allocation of tax items and distributions of cash are separate. Tax items can be allocated in one way, and cash can be distributed in a different way and in different percentages. So the IRS has issued Revenue Procedure 2020-12 and created a safe harbor for carbon capture partnerships. We're going to call that the partnership safe harbor. It's very similar to the safe harbor developed for partnerships receiving the wind energy production tax credit, and contains some references and requirements that relate to the rehab tax credit. These are partnership flip structures. So the revenue procedure says that if a project company, a developer, an investor satisfy all of the requirements set forth in the revenue procedure, the IRS will treat the investor as a partner in the project and will treat the project as properly allocating the tax credit in accordance with the general tax rules for allocations. In treating an investor as a partner, the guidance infers that such investor will be treated as satisfying the economic substance and bona fide partnership doctrines. These are general doctrines that apply to tax advantage transactions that are intended to assure that a taxpayer that invests in a tax advantage transaction is a legitimate investor entitled to the tax credits. Now, the partnership safe harbor here goes through a number of requirements. It defines the investor, deals with the partner's partnership interests, minimum unconditional investment, contingent consideration, purchase rights, sale rights, the types of guarantees and loans that may be used, etc. This list of items is generally consistent with the requirements applicable to wind partnership transactions, with a number of modifications intended to make this structure available for the 45Q credit and taking into account some of the unique requirements of 45Q. So let's go through each of these requirements. An investor, that is the tax equity investor, holds an interest in the project company, in the partnership. Project company here is the partnership. Now, an investor may be an initial partner in the project company or may later become an investor by acquiring an interest, either directly from the project company by contribution, that is through a 721 transaction, or from another partner by purchase. You do not have to be a partner on day one. You may become a partner at a later point in time. You can sell your interest at later points in time and so forth. So the second requirement here is with respect to partnership interest. This is the minimum interest that a developer must have, 1% in each material item of partnership income, gain, loss, deduction, and credit at all times during the existence of the project company. The investor must have a minimum 5% interest in each material item of partnership income, gain, loss, deduction, and credit. Note that it's saying income, gain, loss, deduction, and credit. Doesn't say cash. Cash is different. These are the tax items. So these minimum partnership interest requirements mean that the investor may receive allocations of up to 99% of tax items, which would generally occur during the period that tax credits are being generated. The sponsor only has 1% during that period. Now, after the investor hits its target return or the tax credit period ends, the investor's interest typically would flip down to 5%, and the developer's interest would be increased to 95%. So what you typically see is the investor takes 99% of tax items. Once it hits its return or the tax credit period ends, its interest flips down to 5%, The developer starts with 1% of the tax items, and at the point that the investor has reached its return, the developer's interest flips up to 95%. So what this means is that the structure leaves the developer with the majority of the residual interest in the project following the tax credit period. Now, a third requirement here, and one that is going to require some careful consideration and perhaps some clarification from the IRS, are the bona fide partnership requirements. The investor's partnership interest must constitute a bona fide equity investment with a reasonably anticipated value commensurate with the investor's overall percentage interest in the project company, the partnership, separate from any federal, state, and local tax deductions, etc. The investor partnership interest is bona fide equity investment only if its reasonably anticipated value is contingent upon the project company's net income gain and loss and is not substantially fixed in amount. The investor must not be substantially protected from losses from the project company's activities, and the investor's return must not be limited in a manner comparable to a preferred return representing a payment for capital. These bona fide partnership requirements are potentially internally inconsistent with certain other requirements or permitted protections and guarantees that we're going to talk about in a few minutes. I think that these requirements here will be something that the tax lawyers will be discussing with the IRS and seeking some additional clarification. Now, one thing that is perhaps a little easier to understand is that arrangements to reduce the value of the investor's partnership interest or its economic return, you cannot reduce their interest through fees, including developer, management, or incentive fees, or other arrangements that are unreasonable compared with fees or other arrangements within the industry. What that means is that the developer cannot seek to limit the investor's return by setting up fee arrangements in which it would pay, the developer would pay fees or other arrangements for stripping out the cash and economics and conveying it to one of its affiliates. And again, we'll have to see what is proposed there, but it's something to keep your eye on in structuring. The partner or the investor must have a minimum unconditional investment. On the date the investor acquires an interest in the project, the investor must have a minimum unconditional investment equal to at least 20% of the sum of the fixed investment it's obligated to make, plus any reasonably anticipated contingent contributions. What this means is that looking at the investor's total expected investment in the project, it must put 20% upfront on day one, and that 20% must be at risk. It can be reduced as a result of distributions of cash flow from operations, but it must otherwise be at risk, and the investor cannot be protected against loss of its minimum investment through any arrangement, directly or indirectly, with the developer or any other party to the transaction. The next requirement here is with respect to contingent consideration. you put your 20% up front. You must also have a fixed investment of at least 50%. That is 50% of your investment in the partnership, of the investor's investment in the partnership, must be fixed in amount, that are determinable, not contingent in amount or certainty of payment. The remainder of its expected investment may be contingent. Now, in tax equity transactions, contingent consideration is often referred to as pay-go. It's contributed to the partnership over time as tax credits are generated. If tax credits are not generated, the pay-go payments are not made. Now, pay-go allows flexibility in structuring the consideration paid for an investment where there are uncertainties with respect to issues like production levels. So looking out into the future, if there's uncertainty as to the amount of production or variability in production over time, we can structure the pay-go payments to take that variability and uncertainty into account. Now, the other favorable piece to the contingent payment requirement as set out by the IRS here is that if you are making ongoing or making payments with respect to ongoing operating expenses, which are likely to be variable over time or contingent upon those expenses being incurred, those payments with respect to ongoing operating expenses are not treated as part of contingent investment amounts. They would be effectively different and not counted in determining whether you've satisfied the 50% fixed, 50% pay-go. You would treat those payments with respect or contributions with respect to ongoing operating expenses as separate. That's very favorable to the investment structure. Now, the next requirement is purchase rights. Unlike wind and solar and many other tax credit transactions, where the exit strategy for the investor is subject to a purchase option by the developer would typically have a purchase option at the end of the tax credit period or at a period near the end of that period to purchase the investor's residual interest, assuming that they have hit their flip and earned their return. Here, with respect to 45Q, there can be no purchase option. The developer, neither the developer, the investors, nor any related party may have a call option, that means a purchase option, or other contractual right or agreement to purchase at any time the equipment or a partnership interest at a future date, other than a contractual right or agreement for a present sale. That means the developer may not have a purchase option to buy out the investor at the end of the tax credit period or at any future time. What you may do is, at a point in the future, if the developer desires to purchase the investor's interest, it can offer to buy it and the parties can negotiate the sale at that point in time. But there cannot be a purchase option at the time you enter into the agreement. What you do have as a matter of an exit right for the investor, and this is unlike the wind safe harbor, an investor may have the right to put its interest to the developer at a price that is not more, or that is not more than fair market value, determined at the time of the contractual right to sell. So this allows the investor to have a right to put its interest to the developer, that is, to require the developer to buy the investor's interest at fair market value. It may not put its interest to the developer at an amount in excess of fair market value. So what this does is it restricts the investor from receiving a guaranteed return. So you've been going along for several years, and let's say the agreement says that the investor can put its interest to the sponsor at the end of the tax credit period. It can only do that for fair market value. If it has not earned its return at that point in time, it could not, for example, put its interest to the sponsor at an amount that would cause it to earn its return or keep it whole. So the interest, the fair market value of the interest must be determined at the time the put is exercised. In determining what fair market value means, this would be applicable for purposes of the put, solely for purposes of the partnership safe harbor. Any determination of the market value of the equipment or partnership interest may take into account contracts or other arrangements creating rights or obligations only if those contracts or other arrangements are entered into in the ordinary course of business and negotiated at arm's length. What the IRS does not want is to see that you've got some non-market based agreement that would effectively increase the value of the property above what it would be on a true market basis. The next requirement or next area here is one that's important: guarantees and loans. As a general rule, no person involved in any part of the project company may directly or indirectly guarantee or otherwise ensure the investor's ability to claim the tax credit. In the event that the IRS challenges all or portion of the transactional structure of the partnership. What does this mean? It means that the investor must assume the structural risk with respect to whether it is a partner in the partnership, whether it is a bona fide partnership for tax purposes. I will tell you that in the tax equity world, with respect to other tax credits, this is a risk that is normally assumed by the tax equity investor. It assumes the structural risk with respect to the transaction. No person may guarantee that the investor will receive distributions from the company or consideration for its interest, except with respect to the put right at fair market value. In other words, no person may guarantee a return to the investor. The investor must be taking some risk. Importantly, this does not prohibit the investor from procuring insurance, including recapture insurance, from persons not related to the developer or other parties to the transaction. This was something that we asked the service to include. Tax equity investors are going to be concerned about recapture. They are allowing you to obtain recapture insurance as long as it's from a third party. In the same way, if a tax equity were concerned about the structure, while the developer or sponsor cannot guarantee the structure, the tax equity investor could go out to a third-party insurance company and insure its tax risk. Now, those are the issues around the transactional structure. What about commercial risks? The IRS here was fairly lenient in defining the types of commercial risks that an investor and a partnership could put in place. The investor may receive a guarantee for the performance of any act necessary to claim the credit, including ensuring proper secure geological storage through disposal or use as a tertiary injectant. It may also receive a guarantee for the avoidance of any act or omission that would cause the project company to qualify for the tax credit or would result in recapture. Examples of guarantees include completion guarantees, operating deficit guarantees, environmental indemnities, and financial covenants. So, what does this mean? What it means is that an investor can receive a covenant or an indemnity from the sponsor where the sponsor is assuming the obligation, or a contractual party is assuming the obligation to dispose of the carbon dioxide in a manner that qualifies for the credit, or they are guaranteeing you that they will secure and sequester the carbon dioxide, that there will be no escape, etc. You can have those types of commercial guarantees. You may have take-or-pay contracts. We're going to use take-or-pay contracts here to refer to the type of contracts as a long-term contract for the purchase of carbon dioxide between the project company and an emitter, or between the project company and an off-taker. It will not be treated as a guarantee if it is contains a supply all, supply or pay, take all, take or pay, securely store or pay provisions. What does this mean? What it means is that the project company may enter into arrangements with either the emission source or the off-taker that for example, the emission source will produce certain levels of carbon dioxide over a period of time. And if it does not, it could pay damages to the project company. Similarly, on the off-take, if you entered into a contract with an off-taker who guarantees that it will off-take a certain quantity and dispose of it, and if they are unable to take that, they can pay you, they may be required to pay damages. Those types of situations are permitted. On the other hand, there may be no developer loans to the investor. The developer may not lend any investor the funds to acquire any part of the investor's interest in the project company, or guarantee any indebtedness incurred or created in connection with the acquisition of the interest in the project company. Now, these are the restrictions on guarantees and loans. Let me just go back to the guarantees for a second. We talked about take-or-pay contracts. We talked about the fact that you could have indemnities and guarantees against acts or omissions. You can have supply all or pay contracts, etc. Yet, if you remember back to the bona fide partnership requirements, in which it said that the investor must be at risk with respect to its interest, query whether there is some inconsistency here. There are some things that we're going to have to work through, potentially discuss with the IRS and seek some clarification. The final point of the partnership safe harbor is the allocation of the credits. This is fairly mechanical from a tax standpoint. If the project company generates receipts from its activities relating to carbon oxide sequestration, such as payments for capturing the qualified oxide or for the sale of qualified carbon oxide, so it's got income coming in, then the credit will be allocated in accordance with a valid allocation of the income and sales of the carbon oxide. On the other hand, if the project company has no positive cash flow, has it's sequestering, it only has expenses, it only has losses and deductions with respect to payments it makes out, then the allocation of credits will follow the allocation of the costs of the capture and disposal. That concludes our presentation. I wanted to note for you that we are applying for CLE. You have the course code here, and I think we've provided other links to you. We will now turn to questions and answers. Thank you again for being with us today.
Well, David, that's certainly a full description of all the challenges that are out there, and a lot of it is obviously very deep and involved. And as you mentioned, there's a number of things that are evolving even as we speak now, and we can expect further clarification going forward. Just to remind everybody that we do have the chat function here to be able to take any additional questions that you might have during this phase of the discussion. But David, you know, while we're on that, I did pick up several of these questions, some of them sort of grouped in the same zone, if you will. But I think at the very top of it all, just to remind people that these tax credits are realized only when the CO2 or oxides have been permanently and safely sequestered in an IRS approved plan for measuring and monitoring and verifying. So it isn't something that occurs until the actual physical disposal of that oxide occurs. Is that correct?
Yeah, that's right, Chuck. Now, we are anticipating, in fact, we know that the upcoming proposed and temporary regulations will provide the standards for determining what secure geological formation is, how you would go about sequestering the CO2 in a secure formation. That was something that the IRS and Treasury obviously are not experts in those type of geological issues. They've been consulting with both the EPA, the DOE, and the Department of Interior, all of whom had some input on that. But that is an issue that we will expect to see addressed in the upcoming regulations.
Well, you know, David, to further along in that line of logic, you talked about the beginning of construction and costs that would be incurred in terms of the development of a project. Of course, it all begins typically with the ability to have geologic storage in a situation where it's been adequately characterized and prepared in terms of the rest of the project being able to happen. That geological characterization, the work that's necessary for that to be validated, I did not hear that be part of what would be considered manufacturing expenses for carbon capture, even though it would be incredibly important to have that, but it doesn't sound like it would satisfy the litmus test of what you were describing.
Well, Chuck, I think it depends on which method of determining beginning of construction you're using, whether you are relying on the physical work test or whether you are relying on the 5% safe harbor. the type of cost to do the geological studies, to determine whether or not a particular formation is a candidate for sequestration of carbon oxides, et cetera. Those types of forward-looking studies would be considered for physical work. First of all, they may not constitute physical work. Secondly, they would be considered preliminary activities that are before a point in time at which physical work would actually begin. So clearly would not apply for purposes of the physical work standard. The question is, are those costs incurred for the preliminary studies of a formation to determine whether you can sequester there? Are those project costs that would be capitalized into the overall sequester capture and sequestration project? If they are, then those costs would count for purposes of the 5% safe harbor test for beginning construction.
Well, and to pull on that thread just a little more, David, let's just say that that work gets us to a point where, as a developer, it's clear that that particular location is not the one to pursue, but in fact, another alternative location would now become more of interest. Could that development work be, if you will, transferred to that next project to allow that crediting of the work that's been done in terms of the original business development necessary for the new project?
Good question, Chuck. Basically, we're doing various site works at different locations to determine the suitability for sequestration. We incur cost. We determine that those costs, we determine that certain locations are not appropriate. Is the cost associated with the study for the sites that are not ultimately selected considered part of the total capital cost for beginning of construction? Not entirely clear in my mind. It's possible. One, it gets into some issues in the tax area as to whether those costs would effectively be abandoned and result in a loss to the taxpayer, that he could write those costs off because he's ultimately not using that location, or whether they would be required to be capitalized into the project. I think that there is the ability to argue that both ways. It really gets into a capitalization versus current deduction or loss issue under the tax law.
And understanding that there's further clarifications in front of us, David, how would you summarize kind of where we are in terms of what's necessary next? What are some of the more important additional clarifications that we would expect or hope to see?
Well, Chuck, certainly the guidance that we've received so far is helpful. Hopefully giving folks some ideas as to the amount of work or how they can approach beginning of construction so that they know that they can start on a project before the end of 23 and have it qualify. Important. We now know how to go about beginning to put together a deal with tax equity. But we really need to see this forthcoming guidance in the form of regulations, because currently the issue of what is a secure geological formation, the type of plan that needs to be in place, the standards, the environmental standards that will apply, the term that must be monitored, all of that sort of thing, which will be addressed in the forthcoming regulations. Hard to imagine how you get a project off the ground, at least with respect to sequestration there. But that's also going to apply for purposes of EOR, because there's currently been disagreement as to the standard that applies even for purposes of EOR in terms of the monitoring requirements. It's going to be critical to know that. It's also going to be critical to know, for purposes of investment, what the recapture standard is. Is the recapture standard something that stays in place for a significant period of time? Are you going to have to monitor for potential recapture for 10, 20, 50 years? Or is it something that's going to have a more reasonable time frame associated with it? But tax equity investors, you're not going to be able to bring investors into these deals until the investors have some idea about how recapture, what the recapture period is, what potential recapture liability is, and that sort of thing. So, Chuck, once these regulations come out, and they're currently under review, they were logged into the Office of Management and Budget on, I believe it was Friday, March 13th. So just about, 2 weeks ago, maybe 3 weeks ago, in a couple of days. That whole process of OMB review is something that the current administration put in place. The regulations, unless I'm really actually kind of surprised that those regulations haven't been issued yet. 3 weeks for OMB review is a pretty long time, because they shouldn't be making substantive changes to the regulations unless they saw certain things in there. But, getting those regulations out, I think we're going to see them in a relatively short period of time, unless OMB thought there were some issues there that needed to go back and be further addressed.
Well, David, I guess we're all living in what people describe as a new normal. I don't know if it's normal or not, but it certainly is different and strange. And I would anticipate, and maybe you could perhaps offer a final thought in terms of, as we're going forward, what the appetite for tax equity structures might look like, and maybe contrast that to what had occurred 10 years ago when the wind industry was looking at a similar type of approach, but then really, because of what was going on during the Recovery Act, switched to a much more of a grant kind of a mode, if you will, as opposed to a tax return mode. Do you see something like that potentially in our future?
Well, Chuck, it's being discussed in Washington right now. Both the solar industry and the wind industry have been asking and had hoped to get it into the Senate bill that came out last week to basically convert the tax credit into what they call a refundable tax credit. A refundable tax credit is one where, even if you do not have the tax liability to absorb the credit, then the government, the IRS, will basically just write you a check in the amount of the tax credit. So that is on the table. It was being lobbied. You may even have heard the president made a statement opposing that with respect to wind and solar last week, or might have been a tweet at the time the Senate bill was going through. At the same time that the renewable industry is asking that, the carbon capture industry is similarly in asking for the refundability feature. No one has given up on it. We're expecting another bill out of the House, and I know that both for carbon capture and for the renewable tax credits that, you know, the industries are asking for something similar to the grants that were permitted back in 2009 and the few years after that in the form of refundability.
Sure. Well, David, thank you so much. We're very close to the end of our appointed time. Certainly appreciate everybody joining us for today's session. And as we look going forward, again, reminding everyone that we'll have another one of these next Thursday and throughout the rest of the month of April and beyond, in terms of where the rest of the discussions go around CCUS and IRS guidance, but on other topics related to carbon management. Want to thank not only you, David, for your expertise and depth here today, but certainly the sponsorship from Hunton Andrews and Kurth. We could not have done that without you, and the Center for Carbon Management and Energy at U of H is very grateful for the support that you've provided to us. So I'd like to encourage everybody to understand that, you know, this activity will continue. You can look at our website and certainly have the archive material as early as next week. And we certainly hope you can join us next Thursday for the Sea Change in Energy globally. John Hoffmeister will give us his thoughts around the many headwinds that we currently face, certainly, but there also may be some tailwinds that may be counterintuitive or something that we can all perhaps look for in terms of those signposts as the rest of the world also recovers from what we're all in today. So again, want to thank everybody for their attendance and wish you a safe rest of this week, and hope we see you next Thursday. All the best. Thank you.